Welcome to Explained by a C student. Today we cover inflation and shrinkflation, so let's ring up that TV as bananas and jump into it. Inflation is the general increase in prices of goods and services over time, which means that the same amount of money buys you less than it did before. For example, a cup of coffee that cost $2 last year might cost $2.25 this year. It's not that the coffee has changed, but it's the value of money that has decreased. This matters because inflation affects the cost of living, savings, and purchasing power. When prices rise, people need more money to maintain their standard of living, and current wages haven't been able to keep up with the rate of inflation. On the other hand, shrinkflation is when companies reduce the size or quantity of a product but keep the price the same, essentially giving you less for the same amount or more money. An example would be, a bag of chips that used to be 12 ounces is now only 10 ounces, but it still costs $3. You're paying the same, but getting less. This matters because shrinkflation is a sneaky way to pass on the costs of inflation without raising prices, but it can erode trust between consumers and companies. Here are a few factors that affect inflation. Increased demand. When more people want to buy goods and services but the supply can't keep up, prices go up. Think back to the chip shortage in recent years. Computer peripheral prices were significantly affected. Cost push inflation. When the cost of production, like raw materials or wages, goes up, companies raise prices to cover these costs. California is a perfect example of this, when their minimum wage went up to $20 an hour. Monetary policy. Central banks like the Federal Reserve can influence inflation by controlling interest rates and money supply. If there's too much money in circulation, inflation can rise. An example of this would be Fed Chairman Jerome Powell raising or lowering the federal interest rate. Some causes of shrinkflation include rising production costs. Companies may face higher costs for ingredients, packaging, or labor, leading them to reduce product sizes rather than hike prices. Competitive pricing. In highly competitive markets, companies might avoid raising prices to stay competitive, opting instead to reduce product sizes. Consumer perception. Companies bank on the idea that customers won't notice small reductions in size as much as they would a price increase. Essentially, they hope that you're not paying attention. The effects of inflation have been reaching the wallets of most. Here's what that looks like. Decreased purchasing power. Your money doesn't go as far as it used to, making it harder to afford the same things. Impact on savings. Money sitting in a bank account loses value over time if the interest rate doesn't keep up with inflation. Wage price spiral. Higher prices can lead to demands for higher wages, which in turn can lead to even higher prices, a vicious cycle. And the long-term effects of shrinkflation can lead to consumer distrust. When customers realize they're getting less for the same price, it can damage brand loyalty. Reduced value. Over time, shrinkflation can make products less attractive, as consumers feel they're not getting their money's worth. Hidden inflation. Shrinkflation can mask the true extent of inflation, as the price tags don't change, but the value you get does, which I feel is dangerous because it lulls the customer into a false sense of security when in fact the building has been on fire for some time. So, what can be done to improve inflation and eliminate shrinkflation? Monetary policy. Central banks can raise interest rates to cool down an overheated economy, reducing inflation. Fiscal policy. Governments can adjust taxes and spending to influence economic activity and control inflation. Personal actions. On an individual level, investing in assets that typically outpace inflation, like stocks or real estate, can help protect your purchasing power. Also consider researching retirement funds, such as a 401k or an IRA. This is not financial advice of any sort, just something to research if you're interested. And for shrinkflation, the first step is awareness. Be sure to stay alert to product sizes and compare them over time. Know when you're paying the same for less. If you notice shrinkflation in your favorite product, consider switching to a brand that offers better value. Most brands use the same ingredients and only have slight variations, if any at all. And finally, call out companies on shrinkflation via social media or by supporting movements that push for transparency in packaging and pricing. Don't forget that at the end of the day, it is your money. In conclusion, inflation and shrinkflation are two sides of the same coin, both impacting how much you can buy with your money. While inflation is more obvious, shrinkflation is sneakier but no less important. By understanding these concepts, you can make smarter financial decisions and protect your wallet in the long run. I hope I've been able to help you understand something new from the perspective of a C student. If you're still here, thanks for watching. Please subscribe and tell a friend to tell a friend. I'd love to hear your feedback. Look out for the next video on Explained by a C student.